We've been telling you for weeks that just about every interest rate out there is rising. Okay, mortgage rates, for example, they're at their highest levels since 2011, hitting a 7-year high, rising to 4.66% for the 30-year fixed. But as the Federal Reserve also expects to steadily raise interest rates this year, you need to keep an eye on other existing debt out there. Credit card, interest rate, business loans, all of them ticking higher. But guess what? The median experience of today's money managers is only 8 years. So many of them, maybe even yours, have never dealt with this phenomenon before. But the Murray brothers have. That leads us to what we know, on balance, will be the epic debate of the second half of 2018. In a rising rate atmosphere, where should you be putting your money? Stocks or some form of bonds? The twin brothers, they're diametrically opposed. They're ready to duke this one out. David Murray, co-author of Two for the Money, The Sensible Plan for Making It All Work, along with his brother Jonathan Murray, Senior VP and Director of Wealth Management for UBS, join us. All right, gentlemen, bull-bear debate here. You disagree on this. Jonathan, I want to start with you. You like stocks. David, you like bonds, certain types. But Jonathan, make your case for stocks in a rising rate environment, because they sure did well in a very low rate environment.
Yeah. Well, the key, Liz, is what can keep up with rising rates and rising inflation? And the answer throughout time, as your friend Mr. Buffett says, is stocks. I mean, if today you can capture a great, solid, and growing dividend of 3.5% that will not only be safe and stable, but also rise to keep up with the rising cost of living, why own a 30-year bond that's going to only pay you 3% and not grow?
Which in particular areas of stocks? Just stocks in general? Like Buffett, do you just buy an index like the S&P? Where do you say get in?
Well, I think it depends, obviously, on the investor, but there are some real values out there. I mean, your earlier guests were talking about the value in regional banks, and I think they'll benefit from a rising rate environment. They're going to make more money on their net interest margin. They're going to benefit from increased M&A in the space, and they also benefit from incredible domestic GDP growth, which we've been seeing. So I think that's a good place to start with your advisor, regional banks.
If I don't get to your brother, he's going to jump through the TV screen because he's wearing his Hawaiian shirt and he's all angry. With a smile, you say bonds
guys
in particular.
Are chill. Yeah, I think there's always a position for investors, especially as they approach retirement, to have some of their money in instruments that are not equities. Anybody that went through 2001 and 2007 and 2008 can appreciate that. The idea of losing 20, 25, 30, 40, 50% in your savings at a time when you can least afford to do that, meaning when you're pulling money out of your portfolio, that's a really scary thing. So bonds historically, Liz, have been, I think, a nice buoyant kind of effort towards stocks.
But where?
They certainly
go down
a lot less.
Certainly not longer-term bonds, right?
No, I think if you believe that interest rates are going up the way Jonathan and I believe, you don't want to be long maturities. So shorten your duration, 1, 3, 5 years. Talk to your advisor about laddering bonds. If you ladder bonds throughout 5 to 10 years, every year your bond's going to come due, and you can take those proceeds and reinvest it further out the ladder. It's a great way to maintain more income and reduce your downside. And then lastly, I think floating rate debt is not a bad thing to talk to your advisor about if you believe that rates are going up.
Jonathan, your brother's sitting there in a Hawaiian shirt. He's clearly in retirement mode. I mean, are you looking at him saying, oh, my God, brother, what are you doing?
Are you kidding? You think I want... You think I want to teach water aerobics? I mean, he's going to his Zen yoga class and, pulling weeds. Ask him what he's been doing for the last 48 hours.
You go to water aerobics. You don't teach it. You attend water aerobics. You don't teach it, silly.
Okay.
I think he makes some good points, Liz. He makes some good points about floating rate bonds. I also would add municipal bonds. Tax-free municipal bonds are coming back into favor, especially for wealthy investors.
Well, listen, it's great to see both of you. Jonathan on the right, David on the left, and we know who Mom loves best.
Who?
The one who came out second, right?
Our sister.
Exactly.
Your sister, exactly. Good to see both of you, the Murray brothers.
Thank you, Liz.